This dashboard tracks Rolex Rings FY26 operating revenue. The final figure is roughly 1,144 crores, virtually zero year-over-year growth. Traditional equity analysis interprets a flat top line at a manufacturer as a stall, a sign that a growth-oriented company hit a structural ceiling. That interpretation assumes a normal operating environment. Fiscal year 26 was defined by extreme macroeconomic shocks. Specifically, the company absorbed unpredictable spikes in U.S. auto component import tariffs, compounded by severe global container freight delays that extended transit times by weeks. The disruption was severe enough that a major U.S. customer completely shut down a relevant manufacturing plant, waiting out the tariff uncertainty. Consequently, Rolex Rings supply to that specific U.S. program plummeted to near zero during the peak of the crisis. We are going to deconstruct how Rolex Rings absorbed this massive geopolitical hit without sacrificing its overall top-line scale or its EBITDA margins. The FY26 flat top line is a successful stress test. It provides empirical proof of the company's real-time geographic and operational agility. To understand the resilience, we first have to isolate the negative variable. The primary headwind was a sharp escalation of U.S. import tariffs targeting auto components. The legal mechanism driving this shock was Section 232 of the U.S. Trade Expansion Act. Almost overnight, duties on relevant auto components spiked from a baseline of 3. No actual U.S. customer relationships were severed. The programs remained intact, but the wait-and-watch approach from clients created a massive temporary revenue vacuum. Absorbing a 30% revenue crater in a core export market requires a massive mathematical offset elsewhere in the business to keep the total top-line level. Solving this financial equation required aggressive, real-time supply chain diversion and geographic revenue rotation. This waterfall chart models the FY26 revenue structure, starting with our solid FY25 baseline. When we subtract the isolated U.S. export losses, we see a deep negative impact on the overall top line. The first offset driver came from the European export market. Revenue from Europe expanded by 25% year-over-year. This surge was driven by structural market changes. Global Tier 1 automotive companies aggressively accelerated their China Plus One sourcing strategies, and Rolex Rings captured the demand. The sustainability of this European expansion is visible in the forward pipeline. 60% of all new business nominations awarded in FY26 originated from European customers. The second offset driver materialized in the domestic market here in India. Domestic revenue grew by a massive 50% year-over-year. This domestic demand was broad-based. It included heavy volume in standard bearing rings and auto components, alongside scaling contributions from electric vehicle platforms. When combined on the waterfall chart, the European and Indian growth perfectly fills the void left by the U.S. tariff shock. Global footprint diversification operates as a measurable financial shock absorber, allowing a company to protect its top line even when a primary market freezes. Defending the revenue volume is only half the crisis response. The other half requires maintaining revenue quality. This line chart tracks gross margins across the FY25-FY26 transition, revealing an upward inflection from 49.4% to 51.5%, despite the export disruptions. This expansion was driven by a deliberate multi-year shift in the underlying product mix. The company has steadily transitioned from selling raw, forged components to delivering highly precise, fully machined auto parts. As this area chart illustrates, fully machined products now account for 85% of total component revenue, reducing basic forgings to just 15%. A secondary driver of this margin expansion was optimized raw material management, achieved by shifting from overseas steel to domestic sourcing for specific processes. Looking at Q4 specifically, EBITDA margins remained above 20%, maintaining operational health despite two specific one-time accounting drags hitting the books. First, the company recognized an upfront 22 crore rupee payment for U.S. customs duties. While half of this is receivable from customers in future quarters, it was conservatively expensed immediately. Second, Q4 included a 6 crore rupee charge for legal and professional fees related to settling a historic balance sheet obligation. Adjusting for these one-time expenses, the underlying structural margin of the business is accelerating, supported entirely by vertical integration and that 85% machined product mix. That 6 crore legal expense points to the final and most significant financial milestone of FY26. This timeline maps Rolex Rings' capital structure. In 2013, they entered corporate debt restructuring, imposing severe capital constraints. By 2022, primary CDR dues were cleared, allowing an exit. However, one final legacy covenant remained: a right of recompense. The right of recompense is a contractual obligation requiring the company to compensate its consortium lenders for concessions made during the restructuring period. On March 31, 2026, Rolex Rings honored this obligation in full, executing a final payment of 101 crores. The slate was completely wiped clean. Free of debt covenants and legacy restrictions, capital allocation behavior inside the company shifted immediately. In April, the board utilized its strong cash position to initiate a 180 crore rupee share buyback at 180 rupees per share. The promoters explicitly excluded themselves from participating. This ensures that the entire financial benefit of the buyback flows directly to public shareholders. This shareholder return is backed by high cash generation. The business produced 190 crores in operating cash flow in FY26, absorbing all macro disruptions. That cash flow heavily outweighs the company's capital expenditure requirements, which run between 30 and 50 crores annually. Looking ahead to FY27, U.S. tariffs have normalized back to 25%, allowing delayed customer orders to resume aggressively in the first quarter. Combining the U.S. recovery with European programs ramping from initial 15% volumes toward their 60% peak, the company projects mid to high teen growth rates across FY27 and FY28. The FY26 stress test is complete. With a fortified gross margin profile, an unencumbered balance sheet, and heavily diversified geographic demand, Rolex Rings is structurally optimized for sustained free cash flow generation.